Ladies and gentlemen, today's show, we talk to a certified financial planner. He's got an alphabet soup of designations after his name. And it's important we get into talking about that and why people get intimidated when talking to financial planners, and perhaps even talking about the benefits of dealing with one versus another. But we get into a lot of different areas, including talking about some of our political landscape in Canada. And we even talk a little bit about podcasting and the benefits in business. And so on today's show, we have Ryan Morrissey and talking about wealth management. On the show today, we have Ryan Morrissey, certified financial planner, wealth management specialist. We're going to talk about retirement, and he is the man to talk about that. So, Ryan, thank you so much for coming onto the show today.
Thanks for having me, Neil, and looking forward to it.
Yeah. So, okay, look, obviously, we're going to get into talking about retirement planning, and literally, your slogan is "Let me show you how to retire." And so, we're going to be talking about money, and I love the sound of that. My specialty is real estate and real estate investing, and so I am really looking forward to hearing your thoughts on all things investing and how you really help clients move through those stages. But sure. I also want to get to know a little bit about you. Right now, you are in your firm is in New Haven, Connecticut. Am I correct there?
North Haven, yeah.
North Haven. North Haven.
Yeah.
Okay, great. and but where are you? Are you originally from Connecticut?
I am. Yes. Yeah. I'm actually from Cheshire, Connecticut, a couple of towns over, and grew up there, and lived in another town just a couple towns over, Hamden, before that. And after high school, went to high school in Cheshire. After high school, I went to the University of Delaware, where I studied economics. I'm a big golf nut, so I was on the men's golf team, Division I golf, big time. So, and after school, I took a job with Morgan Stanley, where I spent 9 years in Delaware. Well, about 7.5 actually. I stayed around school, University of Delaware, and then after that, I moved back to Connecticut. Spent a couple more years in Morgan Stanley before I went off and started my own company.
Wow. Okay. So, Morgan Stanley is a heavy hitter in the financial industry.
They are, yeah.
Yeah. And if I'm not mistaken, Morgan Stanley has, they've sent some big heavy hitters to all different areas of finance. And am I correct in saying that some of the Fed chairs have been former Morgan Stanley?
I'm not sure. I think there was one from Merrill Lynch, John Thain, right? That was a couple of years ago. And then was it Paulson, who was the Fed during the 2008 financial crisis? I think he came from Goldman Sachs. It could be in the past, right. Not like of recent memory. But I mean, it's a major, it's a very large company. It's like one of the biggest wealth management companies out there.
Okay, great.
Yeah, so it was a good place to go. I mean, it was when I was getting out of school, I had actually had an internship for a financial advisor between my junior and senior year in college, and I didn't, it wasn't something on my radar that I was interested in doing. But after working there for the summer, I really got interested in it, and I thought it was something that I wanted to do. And the advice that he gave me was try to go to get a job with like Morgan Stanley or Merrill Lynch or one of these big firms at the time that had a very large training program, because that was the key, right? Make sure that you're going to get the right training and knowledge so that you can do the best for your clients and be as equipped as you can to go forward. So it just happened that on the campus of college, I didn't even know there was a Morgan Stanley office that I had walked by many times, never even noticed. Yeah. So I sent out a lot of letters and to different, branches, and they responded that they wanted to talk to me, and I ended up getting a job offer there. So I took the job.
Yeah. Now I got to ask, because I don't think any kid growing up thinks I want to go study economics and go work for Morgan Stanley, although some probably do.
Sure. Yeah.
What was the dream before economics?
Well, I'm pretty passionate about golf, so I think at one point I hoped I could be a professional golfer.
Oh.
But I think I realized like maybe like early on in college, like yeah, that wasn't going to happen. So it was time to figure out how can I keep a roof over my head. And
Right.
yeah, I mean, in college, I wasn't even the way my mind works now. I'm definitely more of an in the moment type person. So
Yeah.
I'm not like
Yeah.
thinking of the future like a lot of my time. Like some people are always kind of living in the future. So
Right.
I didn't really have a lot of thoughts of what I was going to do. I was just focused on doing well at what I was doing at, the current courses I had and the current priorities I had to deal with.
Yeah. Oh, well, let me throw a curveball at you. So if while you were in college studying, what's one thing that you did that you probably don't want the financial industry to find out about?
Well, Neil, I don't know if I want anyone to find out about those things.
I'm kidding. I'm kidding. You got to throw a curveball every now and then.
Yeah.
So you're there, you're studying, and but I'm curious about how you made the shift, because we definitely want to, this podcast is about leadership, and
Sure.
as people are trying to, especially the younger, are trying to figure out, transitioning is a difficult thing right now. I've got teenagers myself, and trying to figure out, well, what do I have to do? What am I going to do? It can be a bit of a difficult shift. Can you say something about what led you from PGA golf to what triggered there that helped you in the transition?
I mean, it's definitely hard. I mean, it was just kind of expected. Like, all my friends that I was friends with in college, when you get to be a senior, all the interviews start, and the companies that are, big, well-known companies are recruiting people on campuses. And so I'd had, friends, oh, I had an interview with this firm and that firm. So I think part of it was just competition, that you want to do as well as your friends, and knowing that, hey, your college is over, time to get a job. So I didn't think part of it was even that I had a choice. It's what you do.
Yeah.
But for me, I mean, the good thing was that I really enjoyed what I was studying and what I was learning. So it was something that I wanted to continue with. I think there's probably definitely jobs that people take because they don't really know much about it, and then they get into it and they're like, oh, this is really not something I want to do. So, now I got to figure out my next move. But for me, this is the only job I've ever had as a financial advisor for over 20 years. And it's something, there's definitely challenges with any profession and job, but it's something that I can't see myself doing anything else at this point.
Yeah. Now, is that because you just have that level of confidence in what you're doing, or because the dream of PGA might be a little bit too difficult with Tiger on the back in golf?
Yeah, I mean, the fact that I couldn't beat Tiger, I knew that, all right, I got no shot here. So.
Well, and it's interesting because I know that as human beings, we're always in a state of some type of transition. They say typically every 18 months, something major is going to happen in your life, and you've got to transition through something. And in my case, recently had some health concerns, and we also we adopted a 13-month-old dog. You might hear him in the background. My apologies, but because there's always sort of some transition, we as human beings can also, if there isn't enough, we can go take some on, and that might be a job change, moving into a new career, or for yourself, going from working at Morgan Stanley to going and opening up your own firm.
Yeah. I mean, just to speak about the transition, I mean, I can think back when I first started Morgan Stanley, like, you're not used to as a college student. I mean, college is pretty easy as far as the time commitment, right? You have classes like 2 or 3 hours a day, and then the rest of your day is free. And now you're going to an office that you're working from, 8 or 8:30 in the morning till 5 or 5:30. And it's like, it even if you're passionate about it, it gets kind of monotonous. And,
Mm.
I remember like some days I just had to go like for a walk, when it was nice out, just to get out of the office, because you're not used to that. So yeah, it's definitely a transition for me. It was then. And, but I guess you kind of adjust to it, and
Hmm.
you get used to putting in the hours that you're going to need to in any profession or career you're going to pursue.
Right, right. I know that for myself, I was working for the federal government, and then I transitioned into my own business. And what I really saw was the opportunity to work for myself and know that my efforts were, and it wasn't even as much as that it was going to reward me, which it has, but rather knowing that I was going to live and die by my sword. There was something about that really resonated for me. And was there something there for you that excited you about making that transition from working for Morgan Stanley to opening up your own firm?
Definitely, yeah. I mean, I think the unique thing about being a financial advisor, for me at least, it's changed a little bit, is that when I started, I had a small base salary that was only supposed to last for a year, but because of 9/11, it ended up lasting a lot longer.
Yeah.
But I still had to go out and generate all my own clients. So in the sense that from day one, like, yes, I was living on the fruits of my labor, because if I
Yeah.
didn't generate enough clients to create a sustainable business, I wasn't going to be in business at a certain
Right.
point. You know, um,
Right.
so that was always continuing. But the thing about going out and starting my own business was that I just the more I was in the business, the more I learned about it, and the inner workings, and realizing that a lot of the services I was getting from Morgan Stanley were things that I could do on my own. And working for any large brokerage firm like Morgan Stanley or Merrill Lynch, they keep a very large percentage of the fees that your clients pay you that they use to pay for the overhead that you need to run your business. But you don't have a choice as to where those
Mhm.
dollars are being spent. Maybe you
Right.
don't need as nice an office as they have, or you need better technology than they're giving you, or you need different staff than they're providing. You don't really have any choice in that matter.
Yeah.
So that was one of the main reasons why I wanted to go out on my own, so that I could have more control over how that money, a large portion of the money my clients were paying me was being spent on the business, to make sure I was giving the best experience for the client, and, to be able to continue to grow the business the way I saw that I wanted to grow it.
Yeah, yeah. That's interesting. I can't say that it was quite that way for me. Obviously, working for the federal government, but one of the things it was, I didn't really see myself working in the financial sector. And getting into investments. One of the things that, coming from my background, very different from yours. Sort of a street thug at one point. Luckily,
Okay.
never got never got in trouble with the cops. No record, which allowed me to transition my life. Quite frankly, that was the blessing in all of that. But I just wasn't sure what was next, and
Sure.
part of it was transitioning into just regular life. And when I did transition into my own business, what I really saw was that opportunity to work for myself, work in an area that I like, real estate. And so I got into residential financing, and then realized this whole world of investments was I could actually offer to other people and didn't have to just keep it for myself. Real estate investing for myself, I thought was amazing. But now
Sure.
you teach a whole different brand of investment strategy. I want to dig into that a little bit. And when you talk wealth management, what does that even mean?
Yeah, right. So I think what it means, like, to the industry, is that you have investing, right? And that's a whole other, that could be many, many podcasts, years, right? And then you have financial planning, which is figuring out where you should be putting your money, how much you should be saving, right? What's best for your taxes, and college planning. And the combination of those two services is what wealth management is. So
Hmm.
it used to be that there were people that just did financial planning, like you'd pay them an hourly or flat fee. They'd help you with your financial planning, but they wouldn't help you invest your money. And then there were people that just invested your money. They weren't going to tell you really where it should be invested, or should you put it in your 401k or your Roth IRA. They just had an investment strategy that you could put money in, and they were going to pick your stocks or your mutual funds for you.
Yeah.
So the combination
of those
is what wealth management is technically.
You just pulled out no, you didn't pull out the bee in my bonnet, but I've got there's one bone I really have to pick, because I think there is a clear conflict of interest in the industry, in that so many financial planners we see, oftentimes their benefit strictly comes from, the products that they're selling.
Sure.
And I'm like, hang on a second. If they're going to make money off of what they're, and oftentimes you can see that on our side in the mortgage industry.
Yeah.
And where, depending on what bank is going to give what commissions, how do you know that this individual that's supposed to be working for you is giving you the best product for you and not giving you what's going to give them the greatest commission? What do you have to say about that when it comes to the financial planning space?
No, that's a great question. So the thing, I don't know how it is in Canada, but in the US, like, I'm considered a fee only financial planner. Mm-hmm. So what that means is that I'm only paid by the fees that my clients pay me. That's my only form of compensation. If I tell my client, go to this bank down the street and refinance your mortgage, I don't get a kickback. If I tell them, you need this life insurance, go out and buy this life insurance, I don't get a kickback. So that's what you really have to look for if you're looking to minimize as many of the conflicts of interest as possible. That's what you're looking for. Whereas the majority of financial advisors, and that term financial advisor is very loosely used. It used to be that you had to be a fiduciary, which is what I'm talking about, which a fee-only financial planner is. Fiduciary being they put their client's interest ahead of their own and disclose any conflicts. But now you don't, anybody can use that title. So you really have to understand like the person you're working with and researching like how they're getting paid.
Oh, okay. Well, that's interesting. In Canada, you're not allowed to use that title without actually having the title, and you've clearly got a whole bunch of letters after your name. And can you perhaps explain some of those designations as well? You have to take a drink, ladies and gentlemen, just before he starts into it, because it's going to be a bit.
Yeah, it's going to be a while. So get comfortable. So yeah, again, there's another problem.
Well, it's intimidating, right? It's intimidating when you talk to someone about finances, first of all, and then when you see all the letters and everything, you're like, I don't know, what am I allowed to ask them and what am I not, and what am I going to look foolish for talking about?
No, it is. And yeah, I mean, a lot of times jokingly, and it's called like the alphabet soup of financial designations, right? That's what they are. The letters that you see after a financial advisor's name. So the one that's probably the most prominent and the most relevant is I'm a certified financial planner, which we mentioned at the beginning of the show, CFP. Yeah. So that is an exam that usually takes people a couple years to go through all the steps to be able to complete. And then it also has a fiduciary requirement that you're supposed to operate as a fiduciary at all times.
Right.
And it's definitely the hardest to attain. So that's really like, if you're looking for one that someone has, that would be the one to look for, because it is so difficult to attain and it has that fiduciary component. There's about almost like 90,000 people that have gone through the process of becoming a certified financial planner. I don't know if that's worldwide or in the US, to be honest. Mm-hmm. And then like, there's a lot of other ones that I have, like a CLU is a chartered life underwriter that's dealing with life insurance and insurances. Yeah. CMFC is a chartered mutual fund consultant, like dealing with setting up portfolios. And CHFC is a chartered financial consultant, which is like financial planning, a little bit of the stuff that the CFP doesn't cover, even though it's very comprehensive. It doesn't cover like everything. So, I mean, there's hundreds of these other designations that you can go, and they're all good, right? It definitely is not a bad thing that someone has other ones besides the CFP. The only point I make is that the CFP is the only one that has a fiduciary oath. None of these other ones do. So they will actually strip people's credentials from them. Every year, you'll read about maybe 30 to 50 people that the CFP board has removed their ability to use the CFP designation because they either violated the ethical requirements or they, did something bad to a client, like you said, invested their money horribly or stole their money, or and they're just they can't use the designation anymore.
Yeah. And it can be really confusing for people, and it's always when people ask me about all these designations and how do I know, and oftentimes, here in Canada, I'm sure in the States as well, one of the benefits is that you have governing bodies that you can verify whether someone actually has these certain designations. And I love to tell people, here's our Securities Commission, go check it up. You can find my name and be able to do that. And people can do the same thing with you. But now, in the midst of that, how do people still run into and come up against like the Bernie Madoffs? Like,
unfortunately, yeah. I mean, the financial in the US, it's FINRA, Financial Regulatory Authority, and then you also have like every state has its own like banking department that oversees advisors too. I think they probably need to do a little better job. And part of it's maybe not their fault. Maybe they don't have the budgets they need to. But I mean, you need to do a background check on whoever you're going to work with. In the US, you either go to brokercheck.com or you can type in someone's name. And if they're a broker, it has everything. If they're a fee-only advisor like me, it would say that they're not registered. And you then have to go to the SEC website, which is iapd.com. And then from there, you can look them up to make sure they're licensed. And you can also, there's a report that you can read on them about, what they offer and what they charge.
Right.
I mean, the number one thing I would tell people is that if you want to minimize, as much of the conflicts, work with a fee-only planner. But there still is a conflict. And the conflict is that I only get paid if someone hires me. So that is the conflict, that if someone hires me, I'm getting paid. So if you want to do it yourself, yes, there's a conflict if you hire me.
Yes.
So but that is the conflict. So there is you can't work with anyone who has no conflict, because if there's compensation involved, there's still a minor conflict.
Right. Well, the challenge that I think a lot of people run into is very simple. You can go to certain advisors or certain planners, and they're not going to charge you anything, because they're going to get their compensation from the products that they refer to you. And as a result, the vast majority of people are going to go in that direction. Hey, let me go here because I don't have to pay anything. I go over here and I've got to pay this guy, and who knows if he's going to give me good advice, right? That guy Ryan, I heard about him, down the street. He actually wanted to be a golfer, I heard on a podcast. He didn't even want to be in finance, so why would I hire that guy?
That's right.
But this is the challenge in the industry, and I'm running into it right now, where I'm working on a development, and we're bringing in a surveyor, for the land. Now, I've had to disclose to the real estate agent involved, saying, do not let the sellers know who the surveyor is, because he's from the location where they are. And, I don't want them talking to him and getting involved in any of that, right? Because it can create conflicts. So you're right. Conflicts can be all over the place, and it really is important for people to do their due diligence, which is nice to say. And oftentimes it's easier to just do business with people that you like, and maybe you've gotten to know and a recommendation from someone else. And I get
do, right? Yeah. They don't do it just takes a couple minutes 10 minutes to look somebody up on Google and go to BrokerCheck or IAPD, and And if you see a bunch of complaints, like,
Yeah.
because once somebody gets a complaint and it's over $5,000 of damages, even if the complaint is dismissed, it has to be recorded.
Yeah.
So if you see like a history of complaints for somebody, that probably means that they had a lot of other complaints that didn't even make it to that point. And so
Mm,
they're probably not somebody you want to work with.
right.
And it's always interesting when you see somebody that has all these complaints and then they're still in the business. That's another thing. They probably should bar a lot of people that have a lot of complaints, but it's
Yeah.
hard to take someone's livelihood away from them, I guess. But
Right. If they're not technically, if they've not been indicted for something, people are allowed to complain. I mean,
well, these
had
are
a gentleman.
complaints. I should say complaints
Yeah.
that resulted in damages being awarded.
Oh, okay.
Yeah, like
Yes.
you
Yeah.
can read about what happened, but if you see that, the complaint was the client, lost $50,000 because their money was not invested the way they want, and then you see that it was settled for 40,000, then there's an issue. If it was
Right.
dismissed, then it's probably just miscommunication or the client wasn't
Right.
happy and they just wanted to complain.
Yeah. Oh, wow. Yes, absolutely. And definitely sounds like something that needs to be addressed. If that can happen and people can hold their license after, multiple,
Yeah,
multiple offenses, that is a concern. We see that in so many industries where even the banking sector for that matter, where you can have all sorts of violations. You pay the fines and everybody
yeah,
carries on and
yep,
and they don't even think about it.
yeah.
Now, with you being in the US, can I get your personal opinion, slightly financial opinion on something that's going on up here in Canada? Do you mind?
The truckers.
The truckers,
Yeah,
they are right now, and I don't care whether you side with the truckers or don't side with the truckers, but we have now passed, we have the Emergencies Act, which is now allowing the government to empower the financial industry, the banks,
sure.
to actually freeze people's accounts and even take the money and redistribute it if they feel like.
Oh, I didn't realize they could take the money too. Okay.
Yep,
Wow.
if they feel like it's not appropriate, or there's all the stuff there, but just freezing the accounts on their own discretion, if they think that someone's
Wow.
falling into that category. Um, to me, here in Canada, that seems like a huge violation. What do you guys think about it from the States watching this nonsense?
I mean, I think that's pretty egregious that they could take someone's money
Mhm.
and distribute it to somebody else. Like, that's crazy. I think that's way over the line.
Yeah.
Yeah, I mean, I'm definitely more of a minimalist when it comes to government. Um, you know, Government's needed for certain functions, but yeah, I think government should have limitations, to take your money and
Yeah.
do some of these things they can do.
Yeah.
'Cause, yeah, I mean, then it's like, where are we headed with this? So we headed to like where our government is controlling us, and we don't
Yeah.
really have control over our lives anymore. That's like the whole reason like the US was founded was because of that very reason, to give
Yeah.
people freedom. And so it is definitely concerning to me.
Yeah.
Yeah.
Yeah, it really is. Even for myself, watching this, and my daughters are like, "Are you for the truckers convoy?" And I said it has nothing to do with whether I believe in the truckers convoy or not.
Yeah.
I said what really comes down to is when your government can start freezing your accounts. Financial institutions can start freezing your accounts because they're they don't like what you're saying, or
Yeah,
it's
that's
literally a voice of
crazy.
opposition.
Yeah.
And and now if the government had really even sat down with them to have a conversation about it, that's one thing. And I think especially where where my kids are involved, they don't know where some of these things come from. They don't have the history on it. They don't have the history on how these countries were, our countries, Canada and
Yeah.
the states, were even founded, and how many other countries this happens, and people, have no ability to do anything, to say anything. And as a result, what happens? All the all the profitable money disappears from these countries and goes to somewhere else, and along with
Yeah.
anyone that can make money. And so it's a slippery slope, I think, when people
It is.
start
Yeah. Yeah.
tampering that way.
It's very concerning that I didn't realize they could do that.
The Emergency Measures Act, which
Yeah.
replaces the War Measures Act, which, interestingly, Justin, the last time the War Measures Act was enacted was Justin Trudeau's father, Pierre Trudeau,
Okay.
who used that, who
Yeah.
happened to be friends with.
Kind of reminds me of that. One of my favorite movies is V for Vendetta.
Oh yes,
And I like it for a few reasons. One, the fight scenes are pretty incredible. The guy with knives fighting guys with machine guns. It's obviously pretty fictitious, but
yeah,
the whole premise is that yes, the government gets to the point where it's totalitarian, right? Tell
Yeah.
you what to do. If you don't like it, put a bag over your head and nobody's going to see you ever again. And there are governments that operate like that, and usually the Western countries are fighting to not make that happen. So it is scary if now we're even moving in a millimeter in that direction, that we're going to tell people you can't say or do what you want, and if you don't like you, we're going to take your money and ruin your business or whatever.
Yeah, and you're a father. The reality is that it's highly unlikely that we will see those types of moves within our lifetime. It's more likely that this is a slide that occurs for our kids or their kids, in their lifetime, right? And so it's really something that you want to do something about now before it gets to that point, right?
Yeah, and whatever party it is, I mean, no other political party should probably have that power to do that, right? Because then they're not going to be out of power ever, and they're just going to get more and more power. And to say absolute power absolutely corrupts usually.
Corrupts, right?
Yeah.
Corrupts completely. So let's talk a little bit about investments, because I want to get to know a little bit more of your thought process. You normally you deal with people that are 50 and over.
Correct. Yes.
And so oftentimes someone who's 50 and over, they've obviously lived a good chunk of life. They've already amassed a certain amount of wealth, and now you're having this conversation with them for retirement, probably because they're already having the conversation with themselves about retirement planning. Why wait till someone's 50 and over to have that conversation?
Well, for me, that was really the people that I felt I could help the most. The training that I received initially at Morgan Stanley, that's what I was really focused on. So I've just, kind of stuck with that. And, that's really my niche. I mean, I know a lot about Social Security, Medicare, long-term care, all these things kind of you think about in your 50s and 60s. So that's the niche that I've targeted.
Yeah.
But yeah, definitely you don't want to wait until you're 50 to think about that. But for me, in my business focus, those are the folks that I specialize in helping.
Yeah. Now with helping people with this retirement planning, 50 and over, does the conversation of cryptocurrency ever come up?
Not really. No. I think I've had one client ask me about investing in cryptocurrency.
So do you think that that's going to be a conversation that needs to be had more often when it comes to investing?
I mean, it's a good question. It's hard to say, right? You're not going to know for a while whether it's a good decision to invest in it because, right, you don't know until it goes up. And if you had invested in cryptocurrency a couple months ago, you'd be pretty unhappy right now because it was at, if we just use Bitcoin, $60,000 a coin, and now it's down in the high 30s, low 40s. So, pretty large decline. But if sitting here 10 years from now, is one Bitcoin going to be worth $100,000 or $200,000, then you're going to be pretty happy you bought it. It's just impossible to know.
Yeah.
But there's so many other things you can buy that within reasonable expectation what the future outcome is going to be, that I don't think you need to really hang your hat on your retirement success being from cryptocurrency.
Now, okay, so let me ask this question, because if we now talk about stock market, one of the things that everybody and their monkey's uncle talks about is, put it in 30 years later, you can pull it out. And so there's always this long-term projection when it comes to stocks. Now you're dealing with someone that's already advanced in age, not old, but they're, if we're talking about 50 years of age or older, how does that change what someone should be looking at when it comes to wealth management portfolio?
Sure. So, I mean, it really depends like when someone's planning to retire, right? So if you're not planning to retire in 10 years, well, you probably should be fairly aggressive with your portfolio, because you're not going to need any of your money for 10 years. And then even when you do need it, you're not going to need all your money on day one of retirement. You're going to figure out, based on your health and how your money's invested, how much of your portfolio you can take out and live off of each year. And the rest of it is going to stay invested so that it keeps up with inflation, and then it's there for you later on.
Right.
So, most people should probably be, at least, there's different rules of thumb out there about how much of your money should be invested in stocks. There used to be one rule of thumb that said, take your age, subtract it from 100. So if you're 50 years old, gives you 50. That's how much of your portfolio you should have in stocks. The rest you should have in conservative investments, bonds, or cash. But that was done a number of years ago when people's life expectancy was lower. Now the belief is maybe you should use like 115 or 120. So if let's say you use 120, the same 50-year-old, they should have 70% in stocks. That's probably like a good estimate, maybe between like 60 to 80%. And why would you want to have any money in bonds right now in the U.S.? The kind of the benchmark for the bond market is the 10-year U.S. Treasury. So anytime you turn on CNBC, you can see that it's hovering around 2%. That means if you buy a 10-year U.S. government bond, you're going to earn 2% interest on the bond each year. That's really not doing anything. If we know that inflation's right now is 7%, 6%. So the reason I'm telling you that is the more you have in bonds, the more you're going to lower your future return. And so then you'd have to ask yourself, why would I ever have any money in bonds? Well, it's there because when we do have stock market declines, if it happens within the, you're retiring in 5 years, you don't want to see your portfolio lose a large percentage. And now you've got to sell things that are down in value to fund your retirement. So that's why you have money in bonds. It's like for your safe money, your mattress money, so that you've got, a number of, if let's say you're retiring in 5 years, if you had 5 years of income in bonds, then you're good for 5 years. If the market crashes, you don't need to worry about it. I mean, you're going to worry about it, but you don't need to sell anything for 5 years. And most likely the average stock market decline is about 3.5 to 4 years. So your portfolio would have come back in value, and you could then start reselling stuff.
Yeah. So what's the biggest conversation that you have with clients when it comes to retirement planning?
Well, usually the number one thing people want to know when they come to see me is, when can I retire?
Right.
Because, it's on their mind. Either they are kind of done with working, either they're not enjoying it anymore, or they have grandchildren that they want to spend time with, or they just want to do something else with their time. So trying to figure that out is one of the first things we help them do. And that's based on, for everybody, everyone's different, because everyone has different expenses and different things that they use their money for. Yeah. So if you've got higher expenses, you're going to need more money. If you've got lower expenses, you're going to need less money. Or if you're not looking to do a lot in retirement, you're going to need less money. So it's working through that, mathematically, just figuring out, all right, what do they have saved up? Depending on how old they are they going to start collecting Social Security? Are they retiring with a company with a pension? So all these things factor into that, those calculations.
Mm. Well, the biggest thing that I'm seeing right now is that, especially with COVID and what all the lockdowns, and obviously we've had a lot more of them up here in Canada than you guys have. I mean, crying out loud, the Super Bowl. You guys had the Super Bowl, and
there was no
tens of
COVID at
thousands
the
of
Super Bowl, didn't you know?
yeah, they put a
Didn't you watch?
moratorium on COVID. Love it, love it. And but meanwhile, here we still have restrictions on how many people can go into buildings and restaurants. And anyways, won't get into that. But
Yeah.
but with as a result of that, what we're finding is that more and more people are realizing that they want to be able to travel, they want to be able to enjoy their life, realizing how
Yeah.
quickly it could, things could change, and so that's really changing the demographic of people that are starting to look at retirement, and it's changing what they want to do in retirement. How does that? How are you seeing it play out in your world?
I haven't seen a lot of change, to be honest, for the people
Mm,
that I encounter. And maybe that's just because of the demographic I target. But I mean, I just took on a new client the other day, and I told them, like, you can retire tomorrow. I mean,
yeah.
the husband, I think he's like 66 and the wife's like 64. But they said to me, no, we want to keep working. He's planning to work another year. I think his wife's going to work another year and a half. But these are people that they've got enough saved up. They could retire tomorrow, but they want to keep working. So,
Mm.
but there's other people, yeah, that I've met with over the years that are like, get me out tomorrow. Like, even even if I have to live on less, just get me out.
Yeah.
And some of them have really good, well-paying jobs, but they're just done.
Yeah.
They're just had enough, and the stress is too much. So, everyone is different.
Do you ever see the flip side where people have a lot of money but are afraid to do anything with it?
Oh yeah, I'm sometimes I'm a little different than other advisors.
Mom, if you're
Yeah.
listening, can you please listen up here? All right.
So, yes, mom, spend your money. Give Neil a lot of it. He needs it. So,
We've got 4 kids and a dog.
that's it. They need shoes, braces, dog food now. There's clients I have, that don't spend any of their money, and I tell them, listen, you can be spending $20,000-$30,000 a year more than you're spending. Like, go spend this money, because if there are things you want to do, you're going to come to a point where you can't do them physically, possibly, right? Like travel things, like retirement. I heard this, I didn't create this, but somebody broke it down into 3 phases: the go-go years, the slow-go years, and the no-go years. And when you're in the go-go years, right, probably in your early retirement, you've still got the energy and the physical ability to do the same things that you were doing most of your life. There's things you want to do. I encourage my clients, like, make a list of some of the big trips that you want to do or things you want to accomplish, and do them now while your health is good and you can do it. I mean, because you just don't know with your health, like even your own situation, like things can come up at any point in your life that can make it hard for you to do things that might be more physically demanding. So while you can do it, do it.
Yeah. And now what do the no-go years look like?
I don't think we want to think about the no-go years.
I get the slow-go years. I've got kids.
Mom's still puttering around the house, as they say in movies. I mean, that's later in life, when you're in your late 80s, 90s. If you're fortunate enough to make it to that point, I mean, most people that make it to that point, they're not doing a whole lot of traveling. I mean,
right.
You might, there's outliers like my grandfather is 96 years old, and he still lives on his own. He still drives, full faculties. I mean, he's a modern miracle. And there are people like that, but there's a lot of people that even in their 80s are just really challenged to physically move around, and, maybe they start to lose it mentally. So you never know.
So you guys heard it first right here on the Leadership to Wealth podcast. Ryan Morrissey says that if you're in the go-go years, you need to make a list
You need to
and
go.
go
Go.
do those things. I'm sure every vacation resort in the world will want to sponsor you now, and
That's right.
hear
Perfect.
you talk about that
I
more
need
often.
sponsorships for my podcast. So.
Do you have a podcast, Ryan?
I do. Yes.
Oh, you have to tell us about it.
Sure. So my podcast is called Retire with Ryan.
Okay.
And it's a weekly podcast about 20 minutes long, where every week I talk about different topics regarding retirement planning. And I just released, I think, my 84th episode. So it's been almost 2 years. I started it in July of 2020.
Oh, congratulations. What made you start a podcast as a wealth management advisor?
Yeah, I think I had wanted to start one for a while, but it's kind of like everything. You kind of like, oh, I'm going to do it. And I never did it. And then I heard another advisor, his podcast, and it kind of inspired me to get going. And he had a course that I took where it kind of taught you how to do a podcast and gave you some contacts. And I reached out to his production company, and they were like, yep, for like $1,000 a month, we'll do X number of episodes, and we charge you no matter what, whether you get it to us or not. So
yeah,
it was a good forcing mechanism that, okay, time to record. And, away I went. And there's weeks where it's a struggle sometimes to do it, and not so much to do it itself, but just like, getting the right content that you want to do.
Right.
But it's been good.
Okay, we've got a couple more minutes left. But I want to ask this, since we've got a whole different direction to go down, because I actually started this podcast right around the same time. It was really off of the pandemic. People were asking me in social media, what to do, and I was responding, talking about start a business. It's a great time while everyone's scared. And how do you do that? And I said, well, if you don't have money, then you can start a podcast. And I don't know how to do that. Okay, fine. I'll start one and I'll show you guys. What have been some of the lessons that you've learned in doing a podcast? Because you're already a busy man with a wealth management firm. How do you have time for a podcast? And what are some of the lessons you've learned from it?
Well, I'd say, a good lesson I've learned was just really time blocking. So for me, it's Tuesdays. I block off my entire schedule on Tuesdays to deal with the podcast. And part of that time could be spent, if I have a guest, just, doing the podcast. It could be preparing for the guest, researching them, putting together like an outline of what we're going to talk about. If I'm doing a solo show, putting together my notes of what I'm going to cover. And so that's been the key for me. Like early on, like I wasn't blocking out a day of the week, and I'd find myself like, I knew it was due, because my podcasts are due by Wednesday evening. And I'd find myself, I'm at the office late on Wednesday. And, my wife's calling me, where are you? I've got dinner. Oh, honey, I'll be home. And, after that happened a few times, like, all right, this can't happen anymore, because it's compromising my responsibilities at home. So I just said, all right, told my assistant, all right, Tuesdays are blocked off from now on, because I need to make sure I can get this done every week.
Yeah. I think that's brilliant. I honestly, it drives me crazy when people say, how do you have the time? It's called time management.
Yeah, exactly. You got to make it a priority. And
that's right.
Yeah.
Block the time off. That's great. Now, I always get asked this question, and so I'll pose it to you. How do you get started? What kind of cameras should you get? And, microphone, do I need all this stuff? And what are what's your advice to people on starting a podcast?
Well, you definitely need a microphone. But I think my microphone was like $70 or $80. This Samsung, what is this thing? Q2 or something I have. So that's a pretty inexpensive microphone you can get. I mean, my podcast, I don't record them, the video aspect of it. So,
So
I
an
mean,
audio only.
so I only have audio, but yeah, I
Yeah.
think you could use your computer if it's got a good enough camera. If not, I don't know, like how much is a camera? A couple $100 maybe.
Yeah, and the better quality. I mean, I think mine was like 2 something.
Okay, so
But
but
I went for,
yeah,
4K,
your camera looks
yeah.
a lot better than mine, so it was worth every penny, whatever it
Yeah.
cost you. Um, but that's really all you need, and then the I think it's what is this software I use to edit it? Audacity is the software that I
Yeah.
use, which is
Yeah.
free.
Yes.
And you could do all your own editing. I mean, the editing I do is if I say something that I missaid, misspoke, or I want to add something in, like that's the editing I do. And then I upload the file to my production company and then they do the other tweaks to it. But you could do
Right.
all that yourself. For me, it's just time management. I don't have the time. I mean, I could find more time, but I don't really want to. So it's easier for
Yeah.
me to give it to them. And then they help with the social aspect of it, putting together the notes and things that go on my website and, the tweets I can put out about the episodes and stuff like that.
So I have to address this. If you're listening right now and you just heard what Ryan said, Ryan is got his own wealth management firm. I do hard money lending, private mortgages, real estate investments, developments. And we are both saying that if you are interested in doing a podcast, you can make the time. It's possible in your busy schedule to do it. And you could even do it yourself. Obviously,
Yeah.
you can leverage other people. I've got my producer, Wyatt, who Cast Flex Media, shout out. And you can have other people assist you in it, but it's completely doable even if you have a busy schedule.
Yeah. I mean, I was told like when I started, the key is consistency. Whatever the frequency of your show is, you really need to keep that up or else
Yeah.
you're going to have a drop off in your audience.
Yeah.
So, for me, like that forcing mechanism is knowing that I'm going to get charged no matter what if I do the episode. And I also don't want to let my audience down at the same time.
Yeah.
So whatever you're going to commit to, you need to find your own forcing mechanism to make sure that you stay on it. Cause you don't want to have, as they call it, podcast fade or, you start it, do like 5 episodes and then no one ever hears from you again. That could be fine if that's all you want. But if you want to keep going, you got to figure something out. Time blocking is definitely a key component in that as well.
Okay, so here's the big question because and I really want to ask this with regard to this from you because you are talking to people about investment all the time. Why invest your time in a podcast?
Well, for me, it's also helpful because I have clients that ask me things. So rather than me typing 20 emails about the same subject, I can just record a podcast episode and say, hey, go listen to this. Right. And then a lot of the content is evergreen in the sense that things, tax laws and things might change, but other things might not. And then I have this content that I can push out if it's relevant, or if someone has a question about something, I could say, hey, go listen to this episode I had, and you can learn about health savings accounts or 401ks, whatever it is. So it's really helpful, I think, to have that content for people to access.
Wow. So you can really use it as a business tool to be able to leverage. You don't have to have the same conversation every time. A client can, a client or a potential client can go listen to your content without having to pay you money. And then based on that, they can make a better decision to be able to come back to you, and they're using their time and your time to the best of its ability.
Yeah, I mean, for me, like I hope it's another marketing channel. I guess time will tell. I mean, I know that I've gotten a few clients from the podcast, but it's been a lot of time and energy to get those couple clients. So it's definitely not worth it if I start calculating how much time I've spent. But because of the evergreen nature of a lot of the content, it will continue to live on. I think that's a kind of a compounding effect that happens where, 5 years from now, I might say, oh, in the last year, I've gotten 10 clients from the podcast. And whereas in the first couple of years, I got 2. because, it's out there and the listenership grows. I'm up to like 1,800 downloads a month at this point.
Wow.
Yeah, so it's been at that level for the last like 3 months. So it kind of goes in waves. It seems to go in like 3 or 400 download increments, where like I was stuck at like 1,200 for a while, and then I just jumped up to like 1,800. And
that's huge when you think about it. You're spending that little bit amount of time every week, and you've got 1,800 people.
Well, it could be some of the same people, but 1,800 times somebody pushed play on one of my episodes.
Yes.
They might not have listened to the whole thing, but they clicked play. So
yeah, that's right. Absolutely. One of the biggest things that I talk to people about when it comes to podcasts, especially if you're in some type of industry where you have visibility, the ability to be able to tell a potential client and potential investor, something like that, go check me out. I'm out there. I'm not hiding. I'm not in some back room. I'm about as public as you can get. And so there is that, you've been doing it for a couple of years. I've been doing it for a couple of years. And so there is that track record, and the messaging is the same from 2 years ago to
exactly.
now.
Yeah, so my tune hasn't changed in what I believe in, and it's not going to. The rules of the game might change, but how I approach them isn't going to change.
Yeah. It really can establish a lot of credibility, and for people that are in business and you're wanting to be able to establish some credibility, there's huge value in doing it. I love it. I love it. It can now we've kind of gone over time here, so I want to give you an opportunity to talk a little bit about what's next for you, and then we'll get to how people.
For me, I'm continuing to grow my business, so I help like 120 families right now. Still have the capacity to take on more, and so continuing to take on more families as they seek me out, and continuing.
How does a family know? How does someone know that they should be reaching out to you?
Well, it'd definitely be somebody 50 and over who's focused on getting help with retirement planning. And so that would be first and foremost. And then, we'd have a meeting, usually a 20-minute phone call, discuss what they're looking for, make sure that we're the right fit. And then from there, we could talk about how we could work together. There's really two options. One is that if they have assets that they're looking for us to manage, we can take them over and help them with that. Or if somebody's looking for financial planning only, or that's really what's most appropriate, then we can help them with that as well. And we do that like on a flat fee, or we'll quote them a fee to work together for the next year to really get their retirement plan in the best order it can be in, and help them get everything nailed down.
Right. So you can definitely take on some more clients. You're enjoying doing that right now. You can see yourself doing that for a while. How do people get a hold of you?
Sure. Well, they can go to my podcast website. It's Retire with Ryan. So retire with RYAN.com. And that takes you to my main company website also. But from there, you can check out podcast episodes, and you can click on the work with us page. And from there, you can fill out some information and we can reach out to you, or you can actually write on there, schedule a time to talk to see if we're a fit.
Yeah. And so the universal question that people always ask, because they want to know, why is this important? Why is this important for me? Why is financial planning important for me?
Well, I mean, unfortunately, all of us have a certain amount of time we can work, right? And you start out in life, and your human capital, right, is what you're banking on. You don't have any other capital. And what you're supposed to be doing is, as your working years are diminishing, right, you're supposed to be building up some assets that can then replace your paycheck when it goes away. So if you don't do that, you're going to probably live a pretty unenjoyable retirement, I would imagine, because if you're just living on Social Security, that's usually not enough to cover, enough bills that you're probably covering with your working. So you need to be doing something to set something aside, whether it's in the stock market and real estate, right? Whatever is most appropriate for you to make sure there's going to be something else there for you.
Yeah. Wow. Making sure there's something else there, knowing how to retire, when you want to retire. And that's the reason that you want to reach out to Ryan. And Ryan, thank you so much for being on the show today, sharing with us, going in a bunch of different directions, and and even making space for my dog on the show today. So,
what is your dog's name, by the way, Neil?
So his name is Onyx, like the stone.
Cool.
But I actually call him Bodhi. For those of you that remember the 1991 Point Break movie with Patrick Swayze.
Oh, yeah.
Yeah. And his name was Bodhi. And he talked a little bit about dog psychology. And so he made me interested in dogs from 1991. So
yeah, I like that.
So that's my nickname for him, is Bodhi.
Cool.
So there you go. And if you want recommendation on dogs, I'll let you know. And
all right, you let me know.
You guys can get a dog yourself. So thanks a lot. All the best on your podcast, and we look forward to hearing more from you as you guys wade through your current president, as we wade through our current prime minister, and as we wade through our investment worlds and helping people through that. So thank you so much for coming on the show.
Okay. Thanks, Neil.